Good morning, ladies and gentlemen. Well, the risk dial is very much stuck at 89, which is a very high reading. If we have a look at what happened last week, and we can see those scores in the table below, basically this little dip down to 75 meant nothing. We went straight back to 89 and stayed there all week. If we have a look at actually historically what that means, those are readings that we had back in, say, 2000, at the beginning of the rally in 2009, and then again, in mid 2012, and then again in late 2016 and throughout the first part of 2017. So just to give you some historical context of what that score of 89 means on the daily charts, this is a very strong trend, and it says that we are probably more at the beginning of a trend rather than at the end of a trend. I know this is very difficult to believe, but that is what such strong readings imply, that this is a risk-on move that is going to continue for quite a few weeks and months. Having said that, we are very, very close to the 22 times forward earnings of for 2021. 170 bucks times 22 gives you 37.40. We are, what, a percent away from there. That is likely to slow down this trend tremendously. I just can't see the market being able to sustain without bonds doing something ridiculous. So, the upside, I feel, is going to be very orderly here. The risk on is not in doubt. The speed of the risk on is, and I think it's much more likely to be a very slow grind upwards with nice little dips that are buyable. But what the very strong score says is that all dips are very, very buyable, unless we go below some trigger points, and we will discuss those later in this video. Before we look at any trigger points though, always, what does the yield curve say? We're getting very good definition here in the 2s, 10s. You can see how this 74-75 area is becoming excellent support, and we keep on bouncing from it. We're getting a cup and handle here. Basically, we are going higher, and the curve keeps on steepening. It's now, to me, one of these trigger points is actually this 74-75 area. If we come back below it, that'll mean risk off. A brief period of risk off as the yield curve flattens. Any flattening of the 2s, 10s is actually going to be 99% in the 10s, i.e. the 10s are rallying, the futures are rallying in the 10s, and that can only mean risk off. But anytime we get down to 75, I think they're going to be buyers, and we will re-steepen again. If we start breaking 74-75, that will be a very good trigger that we are seeing a period of risk off. No sign of it at the moment, absolutely none. Every time we come down, there are buyers. The steepening trend is very much evident. And it's not only in the 2s, 10s, every major sector of the curve is steepening. Here you have the 5s, 10s. As you can see, we are definitely coming down towards something like 73, 74 basis points in 5s, 10s. And my major indicator, which is the 5s, 30s, here we are coming down to this 140 area. We closed the week at the steepest level of the curve since back in 2016. Yeah, I keep on telling you, this area is going to be very, very, very important. The only thing that can kill an equity market is a bond market. If we start going through this area we are in big trouble, because I just don't think that the multiples can be sustained. If the multiples can't be sustained, that those are big moves, just to go from 22 times earnings to 20 times earnings. And let's face it, earnings are really not going to be revalued very much for next year or the year after, with growth being whatever, 2%, 3%, even if it's 4%, it's not going to be a big thing. But a move from 22 times earnings to 20 times earnings is going to be a major, major thing, worth hundreds and hundreds of S&P points. So you can see how important and why this area is going to be so important. If the yield curve really steepens, growth stocks are going to be in big, big trouble. I think the Fed will be able to hold it. They have all the tools, and I'm sure that they are just aware of these levels as we are. And in that case, they should do something pretty dramatic to stop it. But in the meantime, there's absolutely no reason not to believe, and I was completely wrong last week to look for any kind of rally in bonds. It just looks very unlikely that we can do it. The steepening tendency is there, but we're only 7-8 basis points from very, very important level. At some stage we test it for sure, but I think it holds. If we look at TLT, really, 148.90, 149, I think that is the destination for bonds eventually, within, I don't know, 4 to 6 weeks. That is the level that I would love to see them trade for a bounce. I think when we get there, we can have a rotation upward in bonds that's going to help equities. But I just don't see that it's worth playing TLT until he gets down there. The spreads are very clear, and I will show you those later. The asset, the best asset is at the moment equities, followed by gold, followed by bonds in last place. Nothing much is changing there. It is reasonable to expect that this gap gets filled, and you can see how important it is, this 148.90, 149 level. That'll be the time to fight this small downtrend in bonds. Before that, I think it's pointless. Even the strongest bond market, which is the one in Europe, and this is the bobble, the 5-year area, could not do what I thought it could easily do, which was spike down and fill this gap down here. It basically gave up, and as soon as it crossed this line, that was my signal to get the hell out. Could it go up here to minus 68, 69 basis points easily, and probably even to minus 61 basis points? That's where I would expect it to be when and if TLT trades at that 149 area. To me, this market is well and truly stuck. We have very, very good definition developing, saying that this is very much the bottom. So, trading between minus 82 and minus 62 for the foreseeable future, unfortunately. If we look at the Bund, that couldn't stay under minus 60. I would have thought that we are looking at this kind of level, minus 40, when the TLT gets to the 149 area. It's actually quite disappointing that it couldn't break all of last week. It couldn't get above this 153 level on the differential between the 10-year US and the 10-year Bund. It would really need to start powering higher for the states to stay still and to get a rally in the Bunds. That wasn't possible, and therefore I think it's unlikely that we take out these levels in the Bunds. It's more likely that we start looking for stops and head towards the minus 40 level. it's just the way it is. There's absolutely no fundamental reasons for the bund to be very weak, but I would not be surprised to see the market just stop hunting and take people out of their positions. I don't think the bund goes very far. I think when we get to this level, if we get to this level, it's going to be a wonderful long, and therefore that tells me that the move in the TLT at that level of 149 is going to be an absolute gift. But that is for 4 to 6 weeks away. In the meantime, I think in this latter part of December, very little is likely to happen that takes us very much away from where we are at the moment. The one trend which keeps them getting more and more aggressive is the weakening of the DXY. The dollar is basically being sold against everything. How far can we go? I really don't see any reason why 88.44 will not trade soon. We're very oversold in both the weeklies and the dailies, but any kind of a bounce, I think first of all to 91.01 is a sell, and if you get a bounce up towards this, retesting this trend line from the downside to around the 92.50 area is going to be an absolute gift. I don't think there is any alternative to a weaker dollar at the moment. What does that mean for other contracts like the Euro USD? You can see how we are outside of the weekly Bollinger Bands, but having broken out of this area, we are definitely headed towards 125. The one thing that I actually found quite interesting is this chart. This is the Aussie dollar against the US dollar. You can see how we are breaking out from, this is a weekly chart, and you see how we are breaking out of this bull flag that we developed. Very, very important levels have been broken for 2 weeks on the trot now, and the market, any dip back towards 73.80 is going to be bought, and I think it's really on the cards that at some stage you would trade around 81.17. This is going to be another very important level, but the fact that the Aussie is so strong and is leading is another risk-on indicator. The Aussie is a risk currency, very sensitive to the state of risk. It's risk-on, and that tells me that the fact that we are going up here in the next several weeks tells me that the dips in the S&Ps or any risk assets are likely to be bought. Well, with bonds doing not very much, and the US dollar as it keeps on being weaker and weaker, gold cannot do very much but go up. Although it is certainly not at the moment in an impulsive phase. Okay, having said that, what would make it go impulsive? Well, it would first of all have to take out these lows here, which are around the 1915 to 25 area, and then finally it would have to take out this 1975 area. We're just not an impulsive area. I am not a buyer of gold up here. I am a buyer of the dips down to 1765, and if the bonds do something stupid, I think we could easily get another dip down to 1765. I think gold is now a trading market. If you think about it, the DXY has weakened quite a lot, and probably it's given as much of a lift to gold as is likely to get, within a couple of percentage points. It would take quite a bit more weakness out of DXY to push gold very much higher. I think we're in a basically trading range now between 1765 and 1958. This could last quite a while, I think, in gold before we are ready to break up before we have a technical picture which where the bonds have done all the weakness they're going to do, and the DXY has corrected a little bit of the oversold situation. It's going to take a while. I really would not be a buyer of gold at these levels. I think the likelihood of dips down to 1810 for sure is quite high. Not a market that I'm interested in participating at the moment. I certainly would not be short of it. I'm looking for levels to buy, and my levels really haven't changed. 1810 followed by 1765. As far as equities are concerned, in absolute levels, there is really not much to think about until we close below 36.46 in S&P's cash. There is really nothing to even make you think that we are going to be weak here. It's as simple as that. I think we are in one of these periods where the dips are very much contained, and within are within the parameters of the uptrend. There is nothing here or here that suggests that we are in an immediate danger of breaking. In fact, I would have thought that this can last quite a bit more. So there is absolutely no reason not to believe that risk on continues. On a weekly basis, you can see how the wicks are almost perfect, stopping at 36.45. And we're slowly crawling up this Bollinger Band, which is going to be around the 37.50 next week, 37.60. You know how important I think that 22 times 170 earnings is going to be. If we look at even the shortest time frames, you can basically see that nothing is changing. It is holding the levels beautifully. It's holding the moving averages. No reason to assume that next week, at some stage, we're not going to be trading 37.30, 40, 50. I think that is fully priced, but there is absolutely no sign. It's one thing to believe that you're fully priced, but it's another to go short because of it. There is no reason to go short, none whatsoever. There is probably reason to lighten up on your positions in your long-term accounts, but nothing more than that. The one spread that I think is going to be very interesting to trade very soon is this SPY IWM, and whether you want to make it into a butterfly with QQQ is neither here nor there, but the primary spread is the S&P against the IWM, against the Russell. This is a daily chart. You can see from how important this 193 to 182 area is, and how far we have come in such a brief period of time. Basically, this is a very short period of time. In less than 2 months, we have come an awful long way. This is on a weekly chart. You can see basically it's a straight line down, and it's about to catch this very long-term moving average inside, having met basically the targets down here around 185. I am definitely next week, whatever happens, going to start moving my very long-term equities positions out of IWM into SPY, because I'm convinced that at some stage we will be trading around the 2-10 area. We are basically 2 to 3% away on this spread from having a fantastic trading opportunity to the upside. This level is not going to be broken easily, this 182.20, and that is only about 3% away. I'm not saying that we don't get the 3%, but even here I think the opportunity is good, around 185, 186 is where I definitely start going in heavier, and by the time we get down to 182 I'll be completely out of IWM, having shifted everything into an S&P and probably having done some speculative long S&Ps, IWMs. I think it's going to be a wonderful opportunity. I don't really see any reason why IWM should be that strong. It's the multiple is ridiculous. Yes, we've got the vaccine, the reopening trade, and all that, but I just don't think that the reopening is going to be that strong. So I'm fundamentally and technically very happy to do this trade. It is actually very interesting how in this period of extreme outperformance by the Russell, the spread XLF, XLK, I mean, and all spreads against tech have really not moved very much, and in fact are, if anything, looking to be breaking higher in tech, i.e. more tech strength rather than anything else. To me, XLF to XLK has been very interesting. We caught, a very strong move up here, something like 10% outperformance in the in XLF, and now it's looking sick again, isn't it? I mean, it's just not breaking this moving average and, trading around levels that were the breakout. It could be just retesting the breakout, it'll go again, and that would mean more strength in IWM. But it's really not all that inspiring. If we actually look at something like QQQ IWM, as I said last week, I thought this level would hold, and it has held. So the possibility of more strength in tech is definitely there. It would have to break those levels to be anything but bullish for tech. And this is the Nasdaq against the S&Ps, and you can see clearly it's still in this little trading range here. It hasn't corrected any of this huge move that we had in 2020. It's still looking very, very good. And if there's one sector which is pulling again, and that is technology, and it's trading up, and breadth is good, there is very little reason to suspect that we are going to have any kind of meaningful dip in risk. And this lack of any meaningful dip is actually reflected in ITOT against government. As you can see, we broke the previous highs and closed above them for the week. This trend seems very strong. Any dip is bought and will continue to be bought, I think. We are probably, just like the risk dial said, in a period such as this, where the trend of ITOT government is definitely up. We could have some nice dips to below 3 to buy, but that is it. One day at a time, but the trend in ITOT government is certainly up, reflecting what I said earlier. Equities are the strongest asset class, followed by gold, followed by bonds. Finally, a look at volatility. Chart on the right is volatility in the Nasdaq. On the left, volatility in the S&Ps. You can see how they correlate quite well. I think there's more room for volatility to come down in the Nasdaq than there is in the S&Ps, which tells me that, well, hopefully that tech is going to remain quite strong. The whole volatility thing has basically shifted upwards. I think the absolute low that we're going to see is around the 17 to 16 area, and volatility has definitely been lagging the move in the S&Ps. I think that my trade long of S&Ps and long of volatility is probably correct. insofar as there will be much higher spikes on any kind of weakness in the S&Ps in vol, i.e. that's a natural hedge. But I'm not really looking to do anything but trade it. I really don't see volatility spiking up and staying up. I think the spikes are sells, and the dips in S&Ps are buys. This 200-day moving average at some stage is bound to get tested around the 17 area. So I'm really not bullish volatility. I'm more bullish the spread between the S&Ps and the vol. I think any kind of it's psychology almost at the moment. I think as soon as people see any kind of weakness in the S&Ps, they think they're going to be the bag holders at the end of the trend, and they buy puts like crazy, spike in volatility. And that is what I think is happening, and I think that is what you want to trade. Every time it dips, you want to have the volatility on board from when everything was quiet to sell against the dip in S&Ps. Well, nothing much has changed, as you would have supposed in the summary table. The two stands are still steepening. This 75 support is going to be very, very important, since the two stands can only move if the 10s move. Below 75 will indicate some risk off to me, but the first target is 87, and we are heading there. 530s, 140 area is going to be absolutely massive. I don't need to elaborate on that. Levels in DXY have changed very, very slightly. This is still the first real support, 88.44, but the first resistance now is 91, and then around the 92 to 92.50 area. If we see that, it's going to be just a gift, but I don't think we will, not for some time. Gold, I haven't changed anything really. It's got to break this 15.25 to start looking immediately bullish. I don't think it's going to do it. I think that level is a very good profit-taking level for any longs that you might have. There will be more dips, gold being the second derivative of bonds. If we are heading to that 149 area TLT, that'll, gold will not be able to just power higher. 37.40 SPX, I still love that level. Really, you need to see below 36.44 to have any kind of sustained weakness. It just what it is. We are not getting anywhere close to it, and therefore the path of least resistance is still up. 37.40 I think trades next week, and that is my target to lighten up some, but that's about it. NQ has been trading quite well, hasn't it? I mean, it's 12,900 I think is going to be the first target. Nothing's changed in EM. The spreads haven't really changed, 0.5% up, 0.5% down, and nothing's really changed in Nikkei. Still a market I love, and I only trade it from the long side and look to buy the dips. I don't think this 25.6 area is going to, I'm going to see it. Basically, you pick any decent support level from the previous highs, which are now support, and it's headed towards 30,000 without a doubt. But this one I think is going to be the very interesting trade very, very soon. Anywhere near 183 of the SPY IWM, whether you do a butterfly or you do just the spread SPY IWM. And I think this one we will be able to do through options. As I will explain on Twitter, I think this one is going to be quite an exciting one that we can do with a very limited risk, with the potential for a very large gain over the course of 3 to 6 months. We can do some very long-term options with very, very little risk, but I'll explain that one on Twitter next week. Thank you very much indeed, and tweet you on Monday.